And welcome back to the Property Trio, the podcast for the sophisticated property buyer. Today, I'm your host, Mike, and I'm here with the brilliant Cate and the man of the hour, because we're talking mortgage myths. It's our resident mortgage expert, Dave Johnston. Good morning.
Morning,
I
Mike.
love your intros.
He nails them, doesn't he?
I was trying to put a bit of pep into it.
Oh, you're fun.
All right, tell he's had voice training.
Yeah, I've spent a fortune on my media training, Dave. Today thanks, mate. We're taking on a big topic today that has implications for almost every borrower because, of course, when you're buying a house, most of us don't do it in cash. I know Cate with a Range Rover and all that sort of stuff probably does. But we're going to break down some of the most common mortgage myths that lead people to make costly decisions. So let's dive straight in. And don't worry, Dave, I'll have a chance to make fun of you as well. We've got Cate out of the way. Dave, I want to begin with what seems like a no-brainer for most borrowers. People think they should chase the lowest interest rate. And why not? Cheaper is better. And honestly, the banks are all giving us out the same product. Surely that's the best way to go. I mean, why are there even mortgage brokers when you can just say, what's your rate, you know?
Yeah, exactly. I mean, why do you even need to talk to anyone during the process? Yeah. Just look at a rate. I mean, you know, my grade 5 son can work out the lowest rate. He doesn't need it. He shouldn't need any help. If only it was that simple, but there is a lot more to property buying and mortgage strategy than just the interest rate. So, you know, focusing on the lowest interest rate actually can lead to costly mistakes. And we fix this every week at Property Planning Australia. People often come to us after they've DIY'd their refinance. You know, they've dealt direct with an online lender and, you know, they thought at the time they nailed a great rate, but we discover later on that the structure is completely wrong for their long-term plans. You know, so a mortgage strategy is about far more than a rate. The right structure can save you much more over time than shaving a tiny fraction off your interest. And these savings can be through tax deductions. It can be through the ability to hold property for the long term. You know, it can enable you to manage risk, set up a great money management system. So a quick chat with a strategic mortgage broker could have saved many of these people thousands of dollars. And we find almost everyone who comes to us owning multiple properties has some sort of flaw with their loan structure.
Now, Cate, we've got to put a little asterisk underneath Dave because I'm wondering if he's just favouring the lenders that have the best long lunches, you know, and when he's making us pay higher interest rates. I mean, do you have examples of where the structure can actually backfire when it comes to loan? Because, you know, you've got some mortgage skeleton in the closets yourself.
I sure have. And I get to meet people who make mortgage boo-boos and it impacts what they want to do. So sharpest rate is one of the worst things that a borrower can be thinking about. Clearly, we want a good rate. No one wants a silly rate when there's a better one available. But it's your ability to move forward. It's your ability to have control of your asset. And it's your ability to get the maximum benefit of the tax deductions on offer. They're the things that really count. You can look at the cents that you might save when you're going for the very sharpest rate, but you're throwing away a lot of dollars and sometimes a lot of strategy when you take on that really cheap loan product. And in some cases, I've seen a genuine brick wall go up for this borrower that prevents them. You know, they can be locked into a mortgage because they chose a terrible policy without understanding that their circumstances won't enable them to get out of that. And we've talked about people being in the grip of a bad mortgage and not being able to escape it. One of the real life examples that I've seen again and again, and it really upsets me when I help a client purchase a property and they've got great advice and they're set up with an offset account because their strategic mortgage broker has taken into account the future plans that they have. And then they go out on their own and they go rogue and they find some cheap deal and they think that redraw is the same as offset. And that long term, it topples over a lot more than they can imagine. It challenges everything.
Interesting. Well, there's a little bit more to this episode. I thought we were going to be done in 5 minutes when we just debunked Dave and his, higher rate is better stuff. But Dave, let's take the mindset of someone that's shopping around for a mortgage. Obviously, the rate is a factor, but what should they be looking at beyond that interest rate?
Yeah, that's a good question, Mike. Kudos to you for great questioning as host. Okay, so you need to consider the loan structure. You need to consider factors such as repayment flexibility, whether you can use an offset account, and how the loan aligns with your long-term property plans. So, for example, someone who might convert their home into an investment property in a few years would structure their loan very differently from someone who's buying the long-term family home and there's no chance of them ever upgrading.
Yeah, okay. Interesting. Well, let's go a little bit deeper. Let's talk about the mortgage strategies that borrowers actually should be thinking about. Now, Cate sort of referenced something redraw versus offset. In some respects, it's still getting the same money, but what should we be looking at?
Yeah, look, I mean, that's a whole sort of mortgage myth on its own in terms of people not understanding why using an offset is different to redraw. In simple terms, the offset account is separate from your loan. So whereas if you're paying off the loan and then you want to redraw out of the loan, that's effectively considered new money. So, for example, if you're paying down your loan and on a home and then it becomes an investment property later on, you can't get that money back. So that is a difference between the offset and redraw. There's a real material difference because they're separate accounts. A loan is just another bank account, except it's in debit. So, yeah, there's layers to that which we can unpack a bit further potentially in this episode. But look, there are several different strategies. I mean, here are the top ones every borrower should understand. And I love watching clients' eyes light up when I get them thinking about these things. So, look, the first one is offset optimization. So using an offset account helps reduce your interest, but it preserves future tax deductions. And that's the key point. Whereas paying down the loan and then doesn't, and then you're pulling the money out via redraw, whatever you use that money for, that determines whether it's deductible or not what the purpose of that loan was to begin with. So an offset account gives you flexibility without permanently paying down your loan. The second one is money management. A strong money management system uses buckets to improve cash flow control. This will reduce your stress and increases, obviously, your capacity to grow your wealth. You cannot grow your wealth if you are not saving more than you're earning. A money management system will help you to do that. A massive factor if you're going to invest in property or shares and borrow money is you need to optimize your interest deductions. Optimizing deductions means borrowing for investment and business expenses correctly. You need to keep the loan purposes clean by ensuring you do not mix deductible and non-deductible debt. And as I've touched on, if you have a home that you want a stepping stone home to keep as an investment later on, well, if you're going to pay down that debt, that's going to cost you in the long run versus having it in offset. A fourth one is risk management. I mean, let's face it, our loans are where most of our risk lie financially. It generally is the biggest risk factor for us financially, our debt. So it just makes sense that you should have a primary focus of your mortgage strategy is how are you going to manage risk. So risk management involves keeping and building savings buffers, preparing for life's changes, structuring loans to protect yourself from financial shocks. There's a whole raft of ways you can do that with your mortgage strategy. A fifth one is having a strategy to hold properties. A well-planned mortgage strategy makes it easier to hold property when upgrading or investing, helping you build long-term wealth rather than selling too early, which is probably the biggest killer of wealth in the country is people selling properties they otherwise could have held. And a key reason for this is because for most people, the value of one property is the largest asset value they will hold. So if you end up selling one or two or more that you otherwise could have held, that's going to cost you a lot of money in the long run. And then the sixth one is your repayment strategy. It's critical. Your repayment strategy determines whether you use principal and interest or interest-only repayments, and the choice can dramatically affect your long-term wealth, your tax deductions, cash flow, risk management, and ability to hold or grow your property portfolio. So they are the big six, and then there's a bunch of things you can do within each of those.
Well, speaker one for the negative of like the debate of it's all about rate was very convincing on that one. But, you know, you've thrown something on paper that's going to take a little bit more convincing, and that is what you're calling a myth, and that is basically just to pay off your home as soon as possible. Dave, do you dare argue with my grandparents and their complete entire generation's advice?
Look, it certainly was the way my parents grew up of, you know, buy the home, pay it off as fast as you can, and then buy the next home. And that was pretty much the plan. But thankfully, they saw the light down the track and bought a couple investment properties in very well-located suburbs in Melbourne. But that was the old sort of idea. But, you know, look, it really depends. If you plan to live in your home forever that you currently own, and there's no chance that, you know, you might turn it into an investment property down the track, then yes, paying it down as aggressively as possible makes sense. But if there's even a small chance that you will convert it into an investment property later, overpaying can actually cost you a lot in lost tax deductions down the track. Another critical point is, at what juncture do you go, okay, I'm pretty comfortable with where the debt's at. I may not direct all my surplus cash flow into my home. Now I want to direct some surplus cash flow into investments. That's another key, you know, reason why it's not all about just paying off your home loan mortgage as fast as possible until it hits zero and then invest, because you're missing out on the benefit of time and compound growth the longer you take to start investing.
Now, Dave, next sort of question I've got leaves me conflicted, because I am a tax deductions super fan, right? I think I calculated recently that I've been involved in around about $3 or $4 billion worth of tax deductions for investors over my career. But
congratulations!
Thank you, thank you. The ATO not interested in congratulating me on that. In fact, I think I might be assassinated very soon. But you're then also sort of saying something which kind of seems really diligent, is that like overpaying and paying down that debt, which seems to be like a safe position, can actually lead us to a position where we are minimizing our tax deductions. And that kind of keeps me up nights. What are we talking about?
Yeah. Look, so basically in that stepping stone example where you will purchase a future home and you'd love to try and keep this first one as an investment property, it's sort of what you're alluding to there, which, so basically imagine you buy a home and you throw every spare dollar into the loan. Let's say you manage to pay it down by $50,000 extra. Then a few years later, you upgrade and decide to rent out your old home. The problem is that the tax deductible debt on that property is now $50,000 lower than it would have been if you had have kept your savings in an offset account instead. And so you obviously get less interest that's deductible over your life until you retire, or as long as you hold that property.
Cate, Dave's, I'm sure, making reasonable points, but could you explain that in sort of crayon terms, what that means to investors?
So basically, there's interest that you could have been claiming on $50,000 worth of debt, but you can't anymore. Right. So that leads to another myth. Some people think that if they make extra repayments and the money goes into redraw, they can simply pull it back out later and claim the full deduction. But there's a critical difference between offset funds and redraw funds. They might look the same and smell the same and feel the same, but the ATO treats them differently. Redraw, no more deductions.
Dave, so we understand, we need the basic understanding that The interest component is tax deductible if it meets the purpose test. The principal is not. But what can you tell us about that, and particularly the purpose test? Because I remember the ATO for a number of years talking about non-deductible debt. So if you own an investment property and it grows in value and you pull out equity and you buy a jet ski, like I advise all investors to do as prudent financial advice, when we're claiming that as a tax deduction, that's what the ATO is talking about, right? That does not meet the purpose test.
Yeah, exactly. So, you bought that stepping stone home, your initial loan was $750,000, you paid it down to $700,000, and then it turns in the investment property and you go, well, I've got $50,000 in redraw, I'm going to buy the jet ski and take that loan up to $750,000 because that loan was initially used for what is now an investment property. Well, you can't claim because it gets back to the purpose test, which it means what was that money spent on. So 700 of the original 750 was spent on that now investment property that was the stepping stone home, but you pulled out 50,000 from redraw and it went on a jet ski. So as much as that jet ski is lots of fun and you consider it a lifestyle investment, it isn't tax deductible. And that is the mistake people make. And that is why keeping it in an offset account and having that 50,000 build up, so you only pay interest of 700, and then that 50,000 can go towards the future home, then that is the way to do it. So that is what the ATO is talking about. That's the purpose test. And, if you do claim things incorrectly and you get audited, you'll have to pay back a lot of money and you might get fined as well. And it's these types of details that people often get wrong with, particularly as they amass more than one property. And so that is what people need to look out for. But the problem is, look, many people haven't thought that far ahead with their planning, and that's where big irreversible mistakes happen. So a quick piece of advice up front can save you years of lost deductions. And it's a great example of how your mortgage strategy needs to align with your long-term property plan.
I do feel like you're being fun police again. I mean, what if it was like bought with an ABN Mike's Jet Ski Tours Proprietary Limited? I mean, there's got to be, anyway, it's probably another show. We'll keep it sensible. I mean, I feel like that's some pretty powerful advice you've given there that can make a big difference to people's bottom line. So the takeaway that we probably need to lean into for the closing of that particular segment is before you rush to pay off your home loan or pay down your home loan, you might need to really think about how you're going to use that property in the future, right, Cate?
Yeah, exactly. Keeping your options open is always a good strategy. And you'll also have the benefit of having more savings in place in the offset account to use towards paying for the future home and not need to borrow as much.
All right, let's go to another myth. And this is, I suppose, it feeds into that rate discussion. Like, it's all just about the rate. There's nothing different. All buyers advocates are the same. Kate's got no benefit of working with someone that's cheaper. Quantity surveyors are the same. They all have the same rules. So why would you pay, $700 when you can pay $500? There is such a thing as the Australian Prudential Regulation Authority, and they give banks rules, right? There's certain things that they can and can't do. So this myth about your borrowing capacity being the same with different banks kind of seems to fit within that, right, Dave?
Yeah, no, that's false. Not even close. Your borrowing capacity isn't the same with every lender, and it's just another reason to consider different options. So for anyone who hasn't been listening to our podcast for a long time, who has been, you already know this one is way off the mark. Borrowing capacity varies a lot between lenders and different jobs, different types of employment, different types of income. At the end of the day, each lender has a legal team that looks at the rules and regulations they need to meet by APRA or ASIC or whoever provides your jurisdiction, and then they build their own policy around that. And they look to areas where they want to attract clients and the types of borrowers, and maybe areas they don't want to attract certain types of borrowers. And so the lender policy, it's like the law for them when it comes to borrowing, and it's reams and reams of policy papers that then determines how they approach you as a customer and as a borrower. And so it's different. And, ultimately these things go into essentially Excel spreadsheets that have different calculations within them to determine the assessment model. Each lender will have its own appetite for risk and its own way of treating the incomes, expenses, and liabilities. So we see differences in borrowing capacity of many hundreds of thousands of dollars between lenders for the same client, who obviously have the same financial profile. So the difference between a yes and a no often becomes, gets down to which broker you work with. I've been in the game for over 2 decades, so we can confidently say which lenders are favourable for which professions or income types. For a buyer, that knowledge can literally be the difference between buying the home you want or missing out.
That's big differentials, right?
Yeah. And so some of the things that drive those differences, some lenders shade certain types of income more heavily. Some are more flexible with business owners. Others treat bonuses or overtime more generously. Some are stricter with living expenses. Some have tighter rules around existing debts like HECS obligations or credit cards. So the reality is your borrowing capacity is not a single number. It is lender specific.
Cate, have you had examples in building your portfolio where one bank said yes and another bank said no?
1,000%.
Right.
I think that is why lending experts exist. If we all just went to the bank, what I should say is that's a perfect example of why mortgage broking lending experts exist. Because if we all just went to the one bank, we've got their policies and that's what you get and you can't get upset. So a skilled strategic mortgage broker has a lending panel of, as Dave said a few episodes ago, 40 to 50 different lenders. And if those 40 to 50 different lenders have like 10 or 15 products each, that's a lot of loans to choose from. And that is why mortgage brokers are so valued, because they can get you to a lending option where the lender says yes after you've had a hard no.
Dave, I'm interested in the difference between, like the big four, and then we hear a lot about these third tier lenders. When it comes to regulation, do the big four have to jump through more hoops or hurdles, and then the third tiers can be a little bit more fast and loose? Surely they don't have carte blanche to do whatever they like, but are we likely to get better results for them? But then, of course, that's when the interest rate you've got to pay to play happens.
Yeah, so, I mean, banks need to follow APRA's prudential regulation and guidelines, whereas if you're not a bank, you don't need to. So then they need to just follow the specifications, but not with the same specificity at the end of the day. So, for example, banks must have an assessment rate of plus 3% on the rate that you are going to borrow at, whereas they are able to go, well, I think for this type of lender or in this situation, 2.5% is okay. Yep. So they can tinker further, and that's why you can get much higher borrowing capacities with some of these non-bank lenders, because they are able to take greater risks.
So, I mean, people shop around for rate, but there's quite a number of things that we now really need to know that we have to shop around for, right? Or better yet, a broker who is up to date on what's happening with each lender is important, right? Because I'm assuming that you could actually get a yes and a no from the same lender just because of policy changes.
Well, yeah, policies can change, but look, if you've lodged a loan, policies do change all the time from within banks. So it's something you need to stay across. But yeah, like you might get a no from one lender and a yes from another. And it's not because the borrower changed, but because one lender's policy is different to another's. But also it may not be a no. It may be more like you can purchase a new home for $2 million with this lender and 2.5 million with that lender, or 850,000 with this one and $1 million with that one.
You talk to baby boomers and they talk about, I worked for this company for 30 years, or, oh, you need a loan, go and talk to Mark, he's been my bank manager for 50 years. I mean, are those days kind of dead?
Well, they should be. There are still no doubt people who just have a loyalty to one lender for some particular reason. And, there might be people they feel special because they're at private banking with this one lender, and so they just keep talking to them and, they just deal with them. But they're actually sort of cutting off their nose to spite their face and potentially missing out on opportunities. And that, it's another great example for our listeners of why focusing on the interest rate or your favorite lender or bank can be very costly. People may be able to afford a superior home that will better suit them and their family, or to invest in a better location, but they prioritize the rate and the lender rather than the superior home or investment. And that can make a meaningful difference to someone's life choices and the quality of the home they live in, the suburb they raise their family. The ability to not have to upgrade the home again in the future is really, really valuable. That can save hundreds of thousands of dollars over a lifetime. And not to mention all the hassle with moving homes, changing suburbs. Potentially, if you have children, they need to move schools. I mean, these decisions can have a big impact on family life. And often borrowers won't even realize that they're making this choice because they are so focused on the interest rate, or the occasional borrowers are still, just want to stick with this one lender because their parents and their grandparents and great-grandparents always dealt with them. And, that's who they had the bank account with when they were in primary school or something. So, but there's even brokers who may not make people aware that they have more choice. But certainly if they're working with a lender direct, they definitely won't. Understanding the trade-off you're making if you focus on an interest rate or a lender, it might be costing you, the quality of the home that you're buying for your family, or, the quality of the investment.
Well, you said it yourself, hundreds of thousands of difference, and that is meaningful. But let's move on to myth number 4, and that is that consumers can do all the lender research themselves. So, Dave, unfortunately, we thought ChatGPT might make you redundant, but the actual consumer themselves can already do it now.
That's right, yeah. I can't believe why, when I started mortgage broking, it was about 3% of the population, and now it's up at about 70% of all loans are done through mortgage brokers when you can do it yourself and you've got ChatGPT. But obviously people are making that choice because they are getting value. So, look, technically, yes, you can absolutely do all the research yourself. You can compare lenders, read credit policy, and try to figure out which ones match your situation. But here is the reality. On our panel alone, as Cate just touched on before, we have around 40 plus lenders. Our strategic mortgage brokers understand their policies, their niches, their appetite for certain incomes, and their credit behavior. Most clients tell us they had no idea how complex lender policy actually is until they spoke with us. And something we often hear is, I wish I'd come to you sooner. We also hear a lot of, why does the lender even need that? And so, matching clients to the right lender is what we do every day. For a consumer, this would take a huge amount of time, and they don't have the expertise in lending to ensure they are not making mistakes or missing something. That is the reality. So, you can go direct to a lender and speak to someone who is only able to offer that bank's products, and do this with a number of lenders as you do your own research. Or you can work with a very good strategic mortgage broker who has access to many different lenders and has to understand their policies in depth. And the best ones will have strategic knowledge that obviously a consumer doesn't have, just like with any profession.
I think if we take the strategic part out of mortgage broking, we've talked about mortgage strategy and the importance of it. But even if you back that out and you just get a good, solid mortgage broker, they have broad experience. They've got a big toolkit and they've got an impartial viewpoint. Their role is to match you with the right lender and the right structure, not to just sell a single product. And that level of knowledge and objectivity is very hard to replicate on your own. I mean, understanding policy and being able to differentiate the different policies and all of the different borrowers, that takes a lot of experience. And that expertise isn't something that your average borrower is equipped with. And the policy details can be very cryptic and they change often. Further to that, the lenders that are on panels all have BDMs. And so these business development managers are people that the brokers are able to workshop their deals with as well. So it's not just what is on the computer and the computer says no. They have the flex and the reasoning and the experience to understand what to talk out first before going to application stage, because every application is a credit inquiry. So being mindful of that is vital, and most borrowers wouldn't know that behind the scenes.
Yeah, I mean, there's so much that goes on behind the scenes that they wouldn't be aware of. The number of conversations with lenders, people in mortgage broking businesses going into bat for their customers to get loans approved or get things fixed, things going wrong. There's a lot that happens behind the scenes that people just aren't privy to. Plus, mortgage brokers have a legal best interest duty that came in to place as well post the Banking Royal Commission. So that is, brokers must act in the client's best interests. And just to be clear, a lender does not have this best interest duty. They do not have to act in the client's best interests. So if you walk into a lender direct, that lender has no obligation to act in your best interests.
Isn't that heartwarming, Dave? Like, I mean, yeah. I was trying to be devil's advocate for this episode, right? But like, I'm lost on this one. Like, why would you not use a broker that is, like, there's legislation that protects you to make them do what's right for you, but then you go into the bank because they support Collingwood, or that you like their colours, or because grandma has worked with them for years and she says they're the best, but they legally don't actually have to compare themselves to other people. Like, it seems mad.
Yeah, exactly. So they won't even know how to, because they'll be so focused only on their own products. So so a great strategic mortgage broker has to remove that bias. We sit on the client side of the table, and that's the one thing I love about what we do, or one of many. We want clients to have more power than the banks. We want to put the power in their hands. And when it comes to mortgage strategy, many bank staff simply don't have that level of expertise. In fact, many of them have only ever been exposed to working at one lender. So they only know one set of lenders' products. They don't really know anything else. Some of them might have worked across 2 or 3 different lenders, but still that's not being exposed to 20, 30 or 40 different lenders like most mortgage brokers get exposure to. So they're not going to point out if your loan structure is unsuitable, or if there's a better way to set things up, or this lender actually is better at borrowing capacity, but this one's better on rate, these types of things. So, a broker also needs to provide multiple lender options to you. So they need to do that under their regulations. So they're also, regulated in this space where lenders direct are not, which a lot of people do not know. They also have to provide you with a credit proposal and disclosure document outlining their recommendation and the reasons for it, after having compared different options in writing, which, again, lenders don't have to do. So do you think a lender direct is required to do any of these types of things? The answer is no.
Yes, so I can already feel that 70% of transactions with mortgage brokers has gone up to 75 for anyone that's listening to this. One thing that I've found interesting is that there are some lenders that just won't work with, say, me. If I ring them up and say I want a loan, they actually want an intermediary like a broker. And I suppose that kind of makes sense, right? Because banks would love brokers chasing all of the information required for the loan. Whereas if you are a financier that, let's just say, isn't a huge operation, you need to employ a lot of people to be going back and following up and saying, oh, now that you've waited a month to give us that, your previous pay slips are out of date. I mean, that sounds like a bloody nightmare. And I don't know if there's any reason why I'm not a mortgage broker and a quantity surveyor instead, but that would probably be one, as chasing people for that.
Yeah, it can get a bit annoying chasing up documentation and paperwork. No one enjoys that. Customers don't enjoy it. Brokers don't enjoy it. Lenders, I don't think, enjoy all the paperwork. But that's what's come in. More and more, particularly post the Banking Royal Commission. But yeah, look, I mean, if you think about, if we just think logically, if there's 40 plus lenders, there's not too many lenders or banks that have a branch network. So most of them, their distribution channel is mortgage brokers. Yeah. They don't have bricks and mortar. They don't have huge sales team. And that obviously keeps down their overheads and allows them to be nimble, and then means they just need to access the funding to be able to provide it and provide good products that fills a niche in the marketplace. And so, there are certainly lots of lenders who, you can only access through a broker.
If we think about those really painful, chasing up of things, Mike, for the borrower, it's a nightmare and you're sitting on hold. I mean, any of us that have had, something happen with our credit card and we've had to sit on hold, that's painful enough, let alone trying to pull a loan application together. And there's a real scale of efficiency with a mortgage broker. They know how to get the right documentation, have it all together, all there. And in a lot of cases, they know how to get preferential treatment. I mean, you've probably heard the word escalating, Mike, and Dave, you hear it every 10 minutes in your business. There are some files, escalation. There are some that need to go on escalation. And when you've got a mortgage broker that's got a great relationship with the lender or with the BDM, that escalation can happen. I've seen loans go from not approved to certified and ready to settle in 24 hours because of that relationship. That's enormous.
Yeah, look, relationships are a big part of being a successful mortgage broker or operator, that's for sure. Being able to lean on and leverage those relationships when you need to, when things have really gone awry, something's gone wrong, can make a huge difference. If your settlements in 2 days' time and you need something, or to be able to get the bank to agree to act on scanned documents rather than actually receiving them in person, or you've got your customers overseas on holiday when everything's happening. There's all these types of things. Do you really want to be the one liaising with the lender whenever they want another document or clarification on policy? I mean, there's times our staff still have to sit on hold for 20 minutes, 30 minutes, waiting to speak to a lender, but at least they can be going on, doing other bits and pieces of work while they do that. But, when you work with a mortgage broker, we handle all of that stuff. It's why, we have much more back office staff than we do strategic mortgage brokers. And we know how to escalate things. We know who to speak to, and we can interpret what the lender is asking for. It saves time, stress, and mistakes when it's done well. And rest assured, most of the time, something extra will be needed, or the lender will get something wrong. Take the loan offer documents, for example. I would say 1 in 3 or 4 loan offer documents have something wrong with them. And so that's why we review these every time before sending them out. And we might even miss something at times, I must admit. So, we provide a detailed personalised email on what's in them and where to sign, and we offer to go over them with our clients. Rarely does a loan application not have some hiccups between lodgement and settlement. And, thanks to the Banking Royal Commission in particular, lenders require more information about you than ever before.
All right, Dave, let's keep moving with myth 5. Now, this is where the banks differ from, say, Mr. Costello, who said one for mum, one for dad, and one for the country. And he was talking about babies. Now, banks hate babies. They hate maternity leave. I've seen banks pull up people that have bought something at Pumpkin Patch and they were just going to a baby shower and that got them in trouble. So, this is something that is a big consideration for a lot of families. A lot of people want to have children and they're terrified to what actually happens when a bank looks at them and assume that a bank's just not going to, banks and babies just don't go together.
Yeah. Like, can't borrow money and have a baby at the same time. No. Thankfully, lenders, I think initially were, with some of the changes with lender policy and maternity leave, they just went too far and made it really difficult for, if you're pregnant, okay, well, you're going to be off work for a period of time, so we're not going to factor in your income. But thankfully, it's started to move back towards common sense, and it can play a role. So, you absolutely can get a loan while on maternity leave now. We work with a lot of clients during parental leave, and the key is presenting the right story to the lender. They need to see the full picture, not just a snapshot of reduced income. Lenders want to understand your return to work plan, what your income will be once you are back, and your savings buffer to see that it can meet your commitments and expenses while you're on reduced income.
So if someone's on leave, but they have a confirmed return date and a letter from their employer, they can still borrow.
Yeah, that's right, Cate. So the return to work letter is the vital part of the equation. It needs to confirm the job role, employment status, and expected return date. Some lenders will even take the full returning income into account, subject to your overall financial position, even though, that date might be 6 months away, 9 months away, or 12 months away. Others may use reduced income until the person is back at work. The point is, it's absolutely possible.
With babies, it's weird to me that people have such a concrete idea. There'll be mothers that kind of think, right, I'm going to the hospital, have the baby, a couple of Panadol, back to work within the hour. But you don't
Nothing
really
wrong with
know.
that.
That's classic Bake-Off style. But you get this little bundle of joy, and often there's all sorts of chemicals that flood your brain that affect your decision making. Like, I actually love this thing and I want to spend more time with it, and everything's kind of been thrown out, and then they're changing to, look, I actually kind of don't care about mortgages. I want to come back to work part-time and spend more time with this little offspring. How does that work?
Yeah, look, that's still doable, Mike. The lender just needs clarity on what the income will look like. And the more documentation, as much as we all hate documentation, and, sometimes people may not want to ring up their employer and ask for this letter, but that will make it easier to get the loan approved. It needs to come from your employer. You saying, yes, I'm definitely going to go back by this date and I'll be paid this amount, that's not going to cut it. So some lenders will consider paid parental leave income as part of the application, and part-time work they'll also look at.
Yeah, so as we've found out, maternity leave is not a showstopper. It just requires planning and proper documentation.
Yeah, exactly.
All right. We're in the finishing straight now with the final myth. Now, that is about loyalty. Now, loyalty is everywhere. We've got frequent flyer points when you go for an insurance policy. It's, how long have you been with this employer? How many demerit points have you had in the last couple of years? Always trips me up. But loyalty must matter to the banks, but it kind of seems like we see all of this, switch lender and you'll get this reduced interest rate, but then you realize, you see that ad and you're like, wait, I'm paying higher than that interest rate and I've been doing that for 10 years. Why does this new person get this reduction? Like, is loyalty just broken with banks?
Look, broken's a probably a bit stronger word, Mike, but it's certainly not true that if you stay with your bank, they'll keep giving you the best rate that they're offering new borrowers. It's just not the way it works. I mean, it's the same with your utilities. It's the same with private health insurance. Loyalty can actually cost people money. So,
isn't that
banks.
Sad? A beautiful human virtue that bites you in the.
Look, I mean, banks often offer sharper rates to new customers, and that's because they want to grow market share and win new business. Existing customers rarely get those deals unless they refinance to another lender. On the merry-go-round, that is the lending world. So, a bank may be keen to grow market share, so they're offering better deals to new people to come to their business, not to the existing ones. Another has just grown a lot recently, so their actual margins on their current book of business, their back book of loans may be too low. So they then tighten up their rates because they actually don't want so many new clients and they need to grow their margins. So, there's so many metrics that go into running a bank or a lending institution. And a lot of them, not the only product they sell is residential mortgages. So things ebb and flow in terms of where the almighty interest rate sits for new and existing clients.
It is so interesting that so many people assume that because they're loyal to their bank, they're being looked after. But this is captured in 2 words: loyalty tax.
Yeah, exactly. So, banks. It's true that banks, and look, many big organisations rely on complacency. They know that most people will not question their rate. And if they do, the perceived hassle of refinancing is certainly a deterrent. So unless your mortgage broker is negotiating on your behalf, which is something that we do for our existing clients, or you are actively reviewing your loan, you may be paying more than necessary.
So just to be clear to those listening at home, loyalty still equal good. Be loyal to friends, family, partners, but to your bank can cost you money.
That's right. Yeah, yep. Exactly. That should be the heading of this episode.
Good.
Review your home loans and interest rate. I would say, look, every couple of years or so, and be open to switch lenders if your strategic mortgage broker can find a better deal that suits your situation. And in the meantime, if you have a great mortgage broker in your corner, and your mortgage broker will periodically get in touch with your lender on your behalf to see if they can sharpen the interest rate for you, which is, again, something we do. And look, but the reality is sometimes this will work and sometimes, and actually often, it won't work. They won't improve the rate, or they won't improve it as much as if you were to go to a different lender. So, lenders, as I sort of touched on, lenders refer to their existing customers as their back book. If they reduced rates across their entire back book, so that is all their existing customers, they went, all right, let's drop all their rates down to the new best offer. That really impacts their profitability, and it reduces what they'll talk about in terms of, like, with the financial reporting, and the CEOs talking about their net interest margin, or NIM. That is how much money they're making on each loan. So, their shareholders don't want to reduce their NIM, their net interest margin. And that's going to cost them with their share price as well. So, it just isn't as simple as, always getting the equivalent rate if you're an existing customer.
Well, I've learned a lot today. Banks are certainly not humanitarian organisations, and you need a strategic mortgage broker to keep the bastards honest. So that brings us to the end of today's episode. We've obviously covered a lot of ground, busted some of those key myths, even some that were dear to my heart, but, logic prevails. Big thanks to you, Dave, for unpacking all of the strategy, and for Cate as well with your experience. And, of course, to the listeners for joining us. And also, don't forget that you can join us for a live podcast recording early in the new year. If you go to our website, the Property Trio, you can register for that. Now, don't go anywhere though, because it's time for our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
All right, so my gold nugget today is simple. There is a lot of misinformation out there when it comes to mortgages and strategy, and most of it sounds convincing enough to lead people in the wrong direction. So that is why working with a strategic mortgage broker matters. A good broker doesn't just find you a loan, as you've learnt today. Many of you might have already understood, but got more nuance around it through this episode. They'll help you cut through the noise, avoid costly mistakes, and structure your lending in a way that supports your long-term wealth and risk management. So getting the strategy right up front can make an enormous difference to your financial outcome. And remember, you are never on the best interest rate. Every week or two, a new best interest rate will pop up from this lender or that lender, and you just can't refinance every week or every month. That'll cost you more money than it's worth. I mean, from the time you meet with your strategic mortgage broker and then ultimately pick a lender and lodge an application, there'll be a new best rate on the market somewhere else. So you need to stop chasing the rate, get the strategy right, do what's right. Get the, if you're buying a property, get the price point right. Do what's right for you. Get a great rate, but not at the expense of a great mortgage strategy that aligns with your future property plans. And finally, if you're listening and you're thinking, I'm not really sure if my loan is set up properly, you're always welcome to get in touch with me and my team at Property Planning Australia. Even a quick review can cover opportunities most people never see on their own. So you can find a link to get in touch in the episode description.
My gold nugget is short and sweet. If you're thinking about ditching your offset account, do not do so without talking to a professional.
Yeah, I mean, that could apply to anything around mortgage and mortgage strategy, right? Talk to a professional. And the thing that stuck out for me is that these professionals have a requirement by law to do right by you. Bank does not. So bank loyalty, we've thrown into the bin for this episode, and a number of other myths. So thank you guys for sharing that wisdom with us today.
Great episode.
Thanks, guys.